Oil prices edged slightly higher above $59 per barrel in early January 2026, following the U.S. military's large-scale strike against Venezuela on January 3rd, which included the capture of President Nicolás Maduro. So the question is, how will this attack affect global oil prices? And what economic consequences might unfold between 2025 and 2026 as a result? Let's solve this equation. Welcome back, strategists. This is the Resource Equation, your briefing room where data, capital, and strategy collide. New here? Subscribe for weekly breakdowns of what's really moving markets. On January 3rd, 2026, the United States launched a military strike against Venezuela, capturing President Nicolás Maduro and his wife, according to a statement from then-President Donald Trump. This operation followed a series of U.S. actions targeting Venezuelan oil exports, including a maritime blockade and the seizure of oil tankers alleged to be involved in drug trafficking. The Trump administration also designated Maduro's regime as a foreign terrorist organization, intensifying sanctions and military pressure on the country. Venezuela, known for holding the world's largest proven oil reserves, currently produces about 1.1 million barrels of crude oil per day, primarily heavy crude. This production volume represents roughly 1% of global oil supply, with most exports destined for China and India. Despite its relatively small share in global oil flows, Venezuela's heavy crude is significant because nearly 70% of U.S. refining capacity is optimized for processing heavier grades of oil, which are less common globally. Here's where it gets interesting. The attacks did not target oil facilities directly, but the existing blockade and sanctions had already driven Venezuelan oil production down by approximately 25%, according to Amrita Sen, an analyst at Energy Aspects. This decline adds to unplanned outages in other oil-producing countries like Russia and Kazakhstan, which could gradually reduce global crude stock builds expected through 2026. Yet the immediate impact on oil prices has been limited. Industry experts, including Giovanni Staunovo of UBS and Vandana Hari of Vanda Insights, note that the market has so far only factored in a modest Venezuela risk premium, a small price increase reflecting geopolitical uncertainty. Oil prices, which had posted their worst annual performance in 6 years by the end of 2025, edged up by less than 1% following the strike. 3 numbers tell the story. First, Venezuela's export volume of about 590,000 barrels per day last month, which is small relative to the global consumption of over 100 million barrels per day. Second, the roughly 25% reduction in Venezuelan production due to sanctions and blockades. And here's the kicker. Despite this, global oil markets are currently oversupplied, largely due to rapid production increases from OPEC Plus and other producers, softening demand, and the prospect of easing restrictions on Russian oil exports if peace talks progress in Ukraine. Surface level, the limited immediate price reaction reflects this supply surplus and the presence of stored Venezuelan crude on tankers, especially in Asia, which could cushion buyers like China from sudden supply shocks. But dig deeper, and the quality of Venezuelan heavy crude introduces complexities. Heavy crude is harder and more costly to replace with lighter grades, potentially increasing refining costs and putting upward pressure on diesel and other refined products. Pause here. Does this make sense? Drop your take in the comments. Looking at market behavior, prices for Brent crude rose above $59 per barrel after falling more than 5% in the last 4 sessions of 2025. West Texas Intermediate traded near $56. Analysts like Vijay Valecha of Century Financial highlighted that geopolitical uncertainty often triggers volatile price gaps during market openings, citing past examples such as the U.S. strike on Iranian nuclear facilities. However, Valecha also emphasized that Venezuela's contribution to global supply is relatively minor, estimating that a worst-case disruption of up to 1 million barrels per day would be small compared to total global supply near 100 million barrels per day. On the policy front, The U.S. military buildup in the Caribbean and expanded sanctions reflect a strategic effort to curb Venezuela's oil exports and drug trafficking activities. Yet some analysts, including Robin Mills of Kamar Energy, suggest that a military strike could have longer-term implications. While short-term export losses might not significantly affect prices, a change in leadership could eventually open the door for resumed investments and increased Venezuelan production, potentially altering market dynamics over the medium to long term. But wait, there's a twist. The geopolitical tension comes at a time when other supply disruptions are mounting. Sanctions on Russia have led to force majeure declarations on some oil shipments, reducing available barrels on the market. This creates a scenario where lost Venezuelan barrels could chip away at global supply buffers, even if the immediate price impact remains muted. Remember that question about how large the economic consequences might be? We're getting closer. The economic consequences of the U.S. attack on Venezuela extend beyond oil prices. The country's nominal crude export revenue was estimated at $12 billion in 2025, expected to fall to $9 billion in 2026, according to the U.S. Energy Information Administration. By comparison, Saudi Arabia's crude export revenue is estimated at $147 billion in 2025 and $133 billion in 2026, highlighting Venezuela's smaller scale in the global market. However, the disruption could affect refining operations, especially in the U.S. Gulf Coast, where facilities are configured to process Venezuelan heavy crude. Reduced access to this type of crude may increase refining costs and influence the pricing of diesel and other heavy products. Meanwhile, buyers in China and India, major recipients of Venezuelan oil, could face supply challenges if sanctions and military actions persist. Real talk. What's your hypothesis on why the U.S. escalated this move now? Returning to our opening question, how will the attack affect oil prices and the economy in 2025-2026? Here's what we now know. The immediate impact on prices is limited, largely due to global oversupply and stored inventories. However, the heavy crude quality of Venezuelan oil and ongoing geopolitical risks keep a modest premium on prices. Production disruptions add to existing outages, which may gradually reduce global stock builds. Economic consequences for Venezuela are significant in terms of lost export revenue, while refiners and buyers may face higher costs or supply adjustments. Now here's the number that changes everything. Despite Venezuela's large reserves, current production remains below 1.1 million barrels per day, a steep decline from 3.2 million barrels per day 5 years ago. This underlines how geopolitical actions interact with structural production challenges in shaping market outcomes. What comes next? Market participants will watch upcoming OPEC Plus production reports and U.S. inventory data closely. Additionally, any developments in peace negotiations in Ukraine could influence the status of Russian oil exports, further affecting supply balances. The geopolitical situation in Venezuela remains fluid, with potential for escalation or resolution impacting future market dynamics. How do you interpret this? Who do you think will be most affected by these developments? What signals are you watching for next? Let me know in the comments. And if you found this valuable, hit that like button. Quick reminder, this video reports and explains public information. It does not offer investment advice. Now, while Venezuela's oil situation is grabbing headlines, there's another equation being solved in real time. What if lithium dries up? The driest EV crisis yet. If you think today's story matters, you need to see what we uncovered there. Link in the description. Watch it next. Subscribe to the Resource Equation for weekly breakdowns like this. Next up, how shifting rare earth supplies could reshape global tech industries. See you in the next one.